So let's start with something small. Google and Apple.
The Google antitrust case was a long-running saga that had a multi-year run-up to the judge finding the payments that Google made to Apple to be illegal.
It's $20 billion a year.
Those payments were essentially bribery.
Let's talk cable. I want to talk Comcast and Charter. Let's go to wireless. There's so much going on in the world of advertising right now.
Let me start with ad agencies. There's going to be massive disruption in elements of the ad agency world. We should care about the health of the economy and the future employment of all our family and friends. We've seen presentations from people who are developing AI-enabled tools that compress 40 jobs into one click of a button.
So what you're saying is that there are entire scores of industries people can lose their jobs. There's something not quite sitting right with me right now. Hi, this is Steve Eisman, and welcome to another episode of the Real Eisman Playbook. And today I have two guests from one of my absolute favorite boutique firms, Moffett and Nathanson, and I have with me Craig Moffett and Michael Nathanson. Welcome, gentlemen.
Thank you for having us.
Thanks for having us.
So just to give people an idea of the breadth of just the coverage of just the two of you, because your firm covers a lot more, Michael covers Google, Trade Desk, Snap, Roku, Meta, Interpublic, Omnicom, and WTPP. And of course, you have opinions on Netflix and HBO, which we'll talk about. And Craig covers Verizon, AT&T, T-Mobile, Comcast, Cable One, Charter, Altice, Apple, and what's left of Dish. So there's so much to talk about. So let's start with something small. Google and Apple. So if we were here, I don't know, 6 months ago, your firm had a sell rating on Apple. You know, everybody was scared to death about the antitrust situation with respect to Google. Everybody was scared to death by the fact that Apple makes 100% of its, manufactures 100% of its products in China. Where they assemble them is a different story, but the actual manufacturing takes place in China. So everybody was scared to death about the whole trade situation. And then the world changed. So why don't you guys talk about like what happened and where are we?
Well, the one thing I would say, first of all, thank you for having us on. This is
my
a treat
pleasure
for us to be here. The one thing I would quibble with in what you just said is the reason we had a sell rating on it is the world wasn't scared to death about those things, and they should have been.
Yes.
When the Google antitrust case, for those who weren't following it, was a long-running saga that had a multi-year run-up to the judge finding the payments that Google made to Apple, which represent 20% of Apple's operating income.
And it's $20 billion a year.
$20 billion a year.
And it's like 100% margin.
100% margin. So about 20% of the operating income at Apple. And the judge found those payments to be illegal.
Right.
The judge...
In his preliminary opinions.
In the ruling, the judge ruled that those payments were illegal, and so we were going into the penalties phase. So what do you do about that?
Right.
The fact that those are illegal. And by the way, it wasn't.
It was pretty clear too. He was like, "They're a monopolist.
Yes, they are.
They've abused their monopoly
I read
power."
the opinion. There was no. He wasn't quibbling about it.
Exactly.
And those payments, our friend Ben Thompson argued, I think, pretty persuasively that those payments were essentially bribery. Right? It was Google paying Apple not to be in the search business.
Correct.
We'll give you $20 billion for search, more than it can justifiably be said to be worth.
And you stay out of our business.
And you stay out of our business. And the judge found that to be a patent violation of antitrust law. And so when the Biden administration came out and said, we're asking the court to stop those payments, Apple stock never reacted.
Right.
Then the Judge Mehta found Google guilty and said those payments are illegal, and the stock never reacted. The Trump administration came out and reiterated that we agree with the Biden administration that those payments should be stopped, and the stock never reacted. And we put a sell on the stock saying it's just irresponsible to ignore the fact that the courts are telling you that 20% of Apple's operating income is illegal, and they've given every indication it's going away. The market turned out to be right, because at the end of the day, and we'll talk about it in a minute, but at the end of the day, the judge in that case, Judge Mehta, decided we're not going to do anything about it. We're going to leave the payments in place because I can't really figure out what I should do.
And that's because the world had changed.
And in contrast, Alphabet, Google's parent co, was trading at a absolutely low relative market multiple. That the market had really worried about ChatGPT's impact on Google search. And if Apple was to enter the search business, maybe they would buy a Perplexity. And all of a sudden, what had been a very nice duopoly in operating systems and mobile, with Google controlling their side of the street, Apple controlling their side of the street, and sharing and search, would be disrupted. So the opposite of Apple, our stock, Alphabet, was trading very cheaply, and people were very pessimistic about the future.
That you cover.
Yeah, Alphabet. So we kept the buy on, thinking it's in the stock price at this point in time.
Right.
Now, we had spent time with two lawyers who've argued in front of Judge Mehta. And one of the things they said to us is that he's not an activist juror. He's not someone who wants to really – we heard this before the decision. He is not that type of judge who's going to suggest remedies that could be disruptive.
We didn't think, for example, we didn't buy that they were going to force the divestiture of Chrome and things like that.
Yeah. So that was
But you thought he was going to stop the payment.
We certainly thought, well, either stop it or limit it.
Right.
The fact that the decision was we're not going to do anything at all was shocking.
It was shocking.
Yeah. It was a gift.
The opinion basically said, world's changed, I give up.
Yeah.
That's basically what it said.
Yeah. You know, it's a really interesting data point during the case, during the remedy phase, right? The case ended a year ago, August. The remedies were happening over the summer. Eddie Q, I guess the senior vice president of services at Apple, gets on the witness stand and he says to the judge and the court, we're starting to see for the first time searches on Safari turn negative.
I remember that.
And the stock and Alphabet stock dropped 8% that day.
I remember that day.
And that was another gift from heaven because it probably said to the judge, well, the market is seeing something in search that I don't understand because I'm just looking at the historic record.
Right.
But clearly, ChatGPT and AI is disrupting the business in a way that I'm probably too slow to react to. And by backing away from putting his finger on the scale, I think it's a great outcome for Alphabet. But it also is tied to the public markets really looking at Google search as a dead business.
There's a slightly less charitable reading of the same turn of events, though, that the judge instead fixated on AI as an excuse to not have to do anything meaningful.
It could be a combination of both.
And said, I'm scared to death of screwing this up. And
well,
so
I did
AI gives me the
clerk for a
excuse not
federal
to do it.
district court judge one time in my life, and I will tell you that the one thing that federal district court judges do not like is being overturned.
Yeah.
It's an embarrassment to them.
Yeah.
So he was going to go out on a limb regardless. This gave him a real easy out not to go out on a limb.
Yeah.
Yeah.
So let's press Apple for a second.
Okay.
Okay. So now they're still getting the $20 billion, but they still have absolutely no AI strategy whatsoever, as anybody could tell. Sales of the phone are doing a little bit better than people thought, so the stock had a bit of a rally. What do you think they're going to do?
So this is still a device company.
Yes.
Services are great, and the services business is growing nicely. But what's priced into the stock, so first let's talk about it as a stock. What's priced into the stock is the expectation that there is a super cycle. And the original premise of the super cycle, remember, this is a stock that ran up enormously last year into the Worldwide Developer Conference with the unveiling of the AI strategy.
Right.
And the market had rightly sussed out, there is a magnificent market opportunity for Apple here because Apple controls your calendar, Apple controls your wallet, Apple controls your email, and controls your contacts. And so there is an opportunity for an agent on your phone, trusted by Apple because people trust Apple more than any other tech company by a country mile, to integrate all of that and be your AI agent. So I think there's no question that the opportunity to integrate all those things is a real opportunity. The question is who's going to do it, because we've got OpenAI trying to do it. We've got Anthropic, probably not. Anthropic seems to be skewing now more enterprise. But there are all sorts of companies that are trying to attack the same opportunity.
Yeah, but how are they going to attack the opportunity if they don't make a phone?
Exactly.
Well, no, I think that's one of the problems for Apple is that all these, if you want AI on your Apple phone, you can get the app and you
right.
can use ChatGPT or anything else.
But it's not integrated into the whole system.
It's not fully integrated yet. But
Right.
remember, it was a little simplistic to think that Apple was going to control all that anyway, because I'm a typical example. I have an iPhone, but I don't use Apple for my contacts. I use Outlook for my contacts and for my calendar. I use Google Gmail for my mail, or my Outlook for my work mail. And so Apple doesn't really have that sort of privileged a position as you might think. And what's becoming clearer is as they fall behind in AI, they're doing what any sensible company would do, and that is they are increasingly moving to partnerships, and that's all fine. But the partnerships that they're looking for are almost all cloud-based. Remember, most of the activity that's going on right now is cloud-based AI, not device-based AI.
Correct.
And the problem is, if it's in the cloud, it'll probably work even better. But there's no longer any reason to upgrade your phone if it's going to be in the cloud.
Okay.
If it's in the cloud, any phone can do it.
So there's the thesis that we're going to have a massive upgrade cycle could be wrong.
It looks wrong.
Okay.
Well, it's funny. I'm not as bearish on the lead being lost at Apple. I think the Judge Mehta decision allows Google and Apple to work together on AI, and Gemini is a pretty strong model. And there's a history of Google and Apple working together, as we talked about. I think the outcome has to be making Siri much better. And I think Siri will be a white label Gemini. And all of a sudden there'll be, I'm not sure if it's a super cycle, but I think the use case for Siri gets better as time goes on, because it's terrible now.
It's awful.
We'll joke about it.
Right.
But it's not like it's not fixable, right? It's fixable. You see what ChatGPT is doing and Gemini is doing. The products are great. I just think you haven't yet had the partnership get to that point, which is Siri is just white labeled.
I agree. I just
Yeah.
asked
It's not a
the
super
question,
cycle.
how much extra memory do you need in order to run it?
Right.
If by the time it gets there, if you've got 8 gigabytes of memory and pretty much 3/4 of the base of phones that are out there,
How much
then
more
there's
do you
not
need?
there's not a big super cycle.
So we talk about streaming wars all these years. There's this developing set of battles going on where, to your point about the phone, you've got Meta who wants to make a device, OpenAI wants to make a
What type
device.
of devices Meta want to make?
We don't know. It's probably some type of
Ear thing?
earpod glasses, clearly, right? They're
Right.
making those now. I know OpenAI wants to make a device. They don't think it's a necklace. They don't think it's glasses. Maybe it's ear pods as well.
What's that going to do?
Well, it's going to let you talk to AI. It's going to have AI in your head, basically.
Do I want AI in my head?
I don't know. You walk down the street, you say, "This guy looks familiar. Who is this person?" Oh, that's Steve, right?
Okay.
There are all kinds of use cases. My father-in-law is legally blind and macular degeneration for 40 years now, and it's gotten progressively worse. He just got the Meta glasses, and he was literally in tears about how life-changing it has been for him.
Really?
Because he can open the refrigerator and say, which one is the heavy cream, or what's in front of me, or I'm just looking for a glass of water, or there's an Uber, point me to the blue Lexus, or
And it doesn't.
it does, and it's so life changing for someone who's visually impaired, and I think we shouldn't underestimate the number of use cases for new technologies like that. The technologies come out for one purpose, but they get used for all kinds of different things.
What I've learned over the years the hard way is to not dismiss products that have mass quick adoption, like OpenAI. Do not underestimate the end use case for them,
Yeah.
the business case for them.
Okay.
We find a way somehow.
All right, let's switch gears to something that's depressing. Let's talk cable.
I thought New York football teams? No.
We can talk about it.
The Yankees, we
I'm like,
talked to Yankees too.
You open a door to a lot of
Let's talk about.
it's a range of
I wanna-
season starts
I want to
now.
talk Comcast and Charter.
Okay,
because
Craig.
for years and years and years, these were stocks that people owned. They put it away. They never thought about it. They might have looked at it a year later and would say to themselves, still good, still making lots
Well,
of money.
Brian Roberts would have a stock chart,
Yes.
S&P versus Comcast.
Right.
That was in their
And-
deck.
and-
He outperformed for decades until
decades.
he didn't.
Okay,
Yeah.
so now Comcast and Charter sell at like 7 times earnings, which must be a terrible embarrassment to them. They keep losing customers. So talk a little bit about the fundamentals, and if you were Brian Roberts, what would you say? If you're Brian Roberts, dude, the stock's 7 times earnings. You got to do something.
So the fundamental story is pretty straightforward, right? I mean, they were at one point. Let's not go back all the way into the days when they were video players. But when the market finally figured out that they were going to win the broadband wars, they were something close to a monopoly in 75% of the market, and there was a fiber competitor in 25% of the market. And then AT&T started overbuilding fiber, and then others started overbuilding fiber, and interest rates came way, way down during the pandemic to the point where suddenly infrastructure builds with a close to zero cost of capital seemed like they made sense to people. And infrastructure builds became the cat's meow of private equity investment. And so you suddenly had huge amounts of fiber construction in the United States competing with cable. And the narrative—
By the way, what's better, fiber or cable?
The narrative is that fiber is better. The technical reality is they are interchangeable. There really aren't any meaningful distinctions between a fiber network and an HFC or hybrid fiber coax, as it's called, network. In fact, in other countries, there have actually been lawsuits because the cable companies started calling themselves fiber, and the fiber overbuilders sued them and said, you can't call them fiber, they're not fiber. And they won in court because the cable network actually was more fiber than the fiber network was, and closer to being an all-fiber network than the supposed fiber network was. Technologically, they are largely the same. The debate now is how much of the country is going to be overbuilt by fiber. The bears on cable, and the bears are clearly carrying the day for the moment, believe that 80% of the country is going to be overbuilt by fiber, and so there'll be a competitor in 8 out of every 10 cable households. And by the way, you have wireless broadband or fixed wireless access that is now suddenly spread like peanut butter all over the country, and so that's going to take 5-10% of the market. And
so it's a declining business.
And so they view the cable broadband business or the internet access as a declining business for cable, just like video was 10 years ago. There's a completely different narrative, by the way, that I happen to ascribe to that says, first, you can't overbuild 80% of the country. One of my favorite stats is if we're 50% overbuilt today.
Are we?
Something in the range of 50% fiber. It's not, we haven't perfectly built the densest 50% of the country and left the next 50 alone, but it's not that far from that, right? I mean, that's the reality. You build fiber where it's the densest. The 7th decile of population density of the United States, that is the 10% of the country that lives in the 7th decile, is 1/3 as dense as the density of the 5th decile. So if you're going to go from the 5th to the 7th and the cost per mile stays the same, the cost per home pass is going to triple. And nobody's making money if the cost per home triples. So I know everybody says, yeah, we'll get to 70, 80, 90%.
Okay, so
but
let's say the building
that.
stops at 50. So what's the zero bull case?
Well, then I think you reach something like an equilibrium in broadband, and the cable broadband isn't a growing business anymore for subscribers.
It's steady state.
But it becomes a steady state business. Pricing is still growing. Call it 3.5%. So you got 50% of your business with 0 unit growth and 3.5% pricing growth. So call that 1 3/4 or something like that for the overall base. And then you've got a wireless business for the cable operators that at Charter, it's now 6% of revenues growing at 30% a year. So that's another 180 basis points of growth. I'm losing a little bit for video, but overall I'm talking about a low to mid-single digit growth business that's priced as if it's going to shrink 2% a year. And so these are crazy cheap stocks.
Yes, but as I like to say, in good times, people like stories.
Yes.
And in bad times, they focus on balance sheets. And without question, we're in good market times.
Yes.
And so if you're at a cocktail party and someone says to you, hey, Craig, pitch me owning a cable stock. Give me a story. Is there a story?
The story, well, I mean, the story, it's not as bad as you think. It's never a compelling story.
That's not a great story.
In growth times. But the story, I think there is a story, and that is that we're hurtling toward a world of convergence where increasingly people aren't buying a cell phone plan or a mobile plan and a broadband plan. They're buying a connectivity plan that works everywhere, in the house, out of the house, whatever.
Right.
AT&T's building fiber in a lot of places. But at the end of the day, when they've built fiber everywhere they can possibly build it, it will still be less than 1 out of every 4 homes in America. What the hell kind of a strategy is it to say, I've got a solution for 24% of the homes in America? And Verizon will have a solution for 18% of the homes in America. And T-Mobile will have a solution for, today, 1.5% of the homes in America, but maybe eventually call it 4 or 5. Mm-hmm. Cable has a solution for everybody. They can offer a broadband plan and a wireless plan to every customer they have today. And they can do it, by the way, at a huge cost advantage. So if the world really is going in the direction of convergence, cable wins and the telcos lose.
So what do we have to see for people to all of a sudden say, you know what, maybe there's a story here? Because every quarter it's the same story. They lose customers and it looks bad.
You know, I don't think you necessarily need to see cable broadband subscriber losses stop and reverse. I think that's probably too much to ask for. I think you need to see them getting meaningfully smaller.
Okay.
If the losses get meaningfully smaller, it allows you to focus on the other parts of the story, especially wireless, which is the best part of the cable story.
And do you think we're anywhere close to that yet?
I think we're close.
I
think we're close.
But to your point, I think it's representative of a market that doesn't want to invest in slow growth, no growth businesses.
No, not at all.
This is, you've done this as long as we've done this. This feels like the late 1990s in terms of just bull cases and narratives. And there's, we saw this too. It's like we used to work at Bernstein together, and I gave Bernstein some of my parents' money in the 90s when we worked there.
And they were value shop.
Terrible performance.
Terrible.
So I went to see Roger Hertog, the head of Bernstein's, number 2 guy at Bernstein. I said, what should I tell my parents? They've missed out on a decade of not owning Cisco, JDS Uniphase, America Online. And he said to me, this too shall pass. And I think that's the mentality.
Yeah,
It's like, well, this will work our ways. But the problem Craig and I have is that people who used to invest in value are no longer in business.
They're gone.
That's right.
Exactly.
That's right. I mean, put it this way, I always go back to my cocktail party situation. You're at a cocktail party, you're talking stocks. Are people going to want to listen to about Netflix because that's like a great story, or a story about how broadband losses are going to slow?
Exactly.
And so maybe we'll grow revenue 2.5%, 3%.
Right.
Like I'm asleep already.
Except if you're
Okay, so I'm Brian Roberts. Okay, I got to do something more. If I'm Brian Roberts, to get my stock going, then just to have a quarter where instead of losing, 100,000 subs, I lose 25,000 subs. That's nice. But
well, part of it is put your money where your mouth is, right? Managers and owners get blasted for buying back stock, but sometimes you have to put your money where your mouth is and buy back stock. And I think one of the other things that Michael and I lament about the market today is that there really aren't the same kind of price discovery mechanisms that there used to be.
Meaning?
M&A.
Right.
It used to be
LBOs.
that if a business was really misvalued by the public market, then the private market would take it private.
So why did they take it private?
Because most of these things were the companies were too big. There's been so much consolidation. There really aren't take private opportunities. That's not necessarily true of cable anymore. The valuations have gotten so low that they aren't crazy to imagine taking these things private. One small example, but this tells you how completely out of whack it's gotten. Cable One is not a good operator, right? Their prices in broadband are too high. Their operating results are awful. But they're generating 33%, or I should say they're priced such that they have a 33% free cash flow yield.
Wow.
There's no risk of them going bankrupt.
Right.
Their balance sheet, they're levered, but they're not over levered. They're not at risk of default. At some point, a private equity guy has to come in and say, wait a second, you're telling me I can buy this thing and clip a coupon for 3 years and be money good and then still own the asset for nothing?
Right.
And then
so you think
turn
that may
around-
be coming?
So I think you'll eventually start to see the private equity world say, and by the way, the other way to think about it is I mentioned before that private equity is pouring money into all these fiber overbuilds everywhere. A typical fiber overbuild is costing something like $4,000 per connected home. It's about, I won't go through all the math, but figure, $1,200-$1,300 per home passed, and then you eventually get to cost per connected home. So I could be building at $4,000 per connected home, or I could buy Cable One for $1,300 per connected home. At some point, if I'm, whether it's Apollo or Blackstone or somebody else, I'm going to say, that doesn't make any sense. I should be putting money into buying one of these small companies and not just pouring more money into the ground in these speculative fiber builds.
Yeah, if you really want to kick up a firestorm, ask Craig about NBC inside Comcast, because Brian has diversified into media, and judging by the stock price, it's really not worth, right?
No kidding.
Right. So it's a subject we don't really ask anymore because the answer is we're not going to diversify. We're not going to do anything major.
Yeah.
Right.
But I mean, you know better than anybody, right? The reason companies have a conglomerate discount is because if I'm an investor and I want to take the free cash flow from the cable business and invest it in pharmaceuticals this year and energy stocks next year, that's my privilege.
Right.
If Brian Roberts diversifies, he's going to decide what happens to that free cash flow. He's going to invest it in media. What if I don't want to invest it in media? And so inevitably, there's going to be a discount when you create a conglomerate. And that discount's not going away because, unfortunately, I think, for the shareholders, there's never been any industrial logic or strategic logic for why the media business and the cable business are under the same roof.
Just I'll give you a rationale. That's what he liked.
That's what he liked,
exactly.
right? Now, but by the way, you could go back into the annals of history when there was logic. John Malone saw what that logic was, and that logic was, if I own both of them, I can extort one side or the other.
Right.
and build liberty into real asset.
Right. But then once that became illegal, and it was one of my favorite quotes ever was from Rupert Murdoch, who said, once they put in all the laws, it took all the fun out of being vertically integrated. Right. And so there was no longer any reason to be vertically integrated. He tried to get his hands on DirecTV and then sold it because it just didn't make any sense anymore. And unfortunately, that logic was already gone by the time Comcast was turned into a media and distribution conglomerate. There's never been any strategic logic for why they're together. I don't think it's likely they're going to separate, but it is what it is.
Okay. All right, let's switch gears again. Let's go to wireless.
Oh, good.
So
We're going to talk media.
and then we're going to go to advertising.
Okay.
So I've owned T-Mobile for a very, very long time.
You're a lucky man. It's been a fantastic
And it's
thing
been
to
a
own.
great stock. And the basic thesis of T-Mobile has been that it's the least expensive network. They're the most efficient operator. They operate the best network. And so every year they pass on some of those cost saves onto their customers and they keep taking share. Is that story still intact? Please tell me, because I have a big position.
Well, yes, but.
Yes, but.
So this was my number one stock pick for 12 years. I loved T-Mobile, and I finally downgraded it, not partly because
When did you downgrade it?
about a year and a half ago, and it has had another run since.
Yes, it has.
Or maybe it was even a little longer, and it turned out to be the right call to downgrade it. It traded sideways. I just downgraded it to neutral and said it was finally fully valued after 12 years of rallying. Mm-hmm. And it traded sideways for about a year and then started to rally again. The problem so there's two problems. One is eventually the valuation catches up with the reality. So yes, it's the best operator, and yes, it
sells
has the
at
best
double the
network,
multiple.
and but it sells at double the multiple, right? And if you just think, so what's embedded in double the multiple? It is a terminal growth assumption that says I am going to grow at 3 or 4% faster than the industry I'm in forever.
Correct.
Now, that's a hard thing to do, right? Forever's a long time when you have reasonably low interest rates like we have now, right? And so ultimately you say it's now priced in. And I still agree that
Is the story still intact?
The story is still intact. The valuation prices it very fully. And the problem, and one of the reasons we've been cautious about the wireless business for the last 8 months or so, is this is a business that, especially T-Mobile, still demands from the market that you deliver subscriber growth.
Right.
Postpaid net adds, especially as they call them, for postpaid phone subscribers. It's an industry that generates, call it 8 million phone subscribers every year in the United States, way above the population growth rate, by the way, which is already a little inexplicable given that it's a fully saturated business. It ought to be growing at about the population growth rate. But out of that 8 million subscribers that are being added every year, we're reducing immigration this year by some estimates by 2 million people. We're going to reduce student visas by another 250,000 to 500,000.
Okay.
So you've got 2.5 million fewer people getting phones this year than last year, and yet the expectation for
subscriber growth to be the same.
is to be actually slightly higher than it was
Really?
last year.
Okay.
And so we just said that's a bad bet. Now, it hasn't shown up yet, and maybe we'll be wrong, and they'll just keep manufacturing net adds out of vapor. But it just seems like a bad bet to say in an industry that grows by 8, if you take away 2, it's probably not going to go up to 9, right?
I think I learned that in 3rd grade.
But you know what? It's funny because watching you ask Craig the question is, has the story changed?
Right.
What I think has happened in our world since we started being analysts is valuation, ceilings are no longer a thing.
As long as the story is intact.
Exactly.
Yes.
Like I said, today we live in a world of stories, and the fact that a stock has a 40 multiple where you once thought it maybe should be a 25 multiple
Right.
is not relevant
Right.
in this world.
And
until the fundamentals change.
Right. And if you ask me again, like on a Netflix, which Robert covers for us, we have a buy on it now, but all those years, I'm like, I can't see paying 40 times EBITDA.
Right.
For
But nobody cared.
Yeah.
And no one still cares about any of this stuff.
I'll tell you a funny lesson that I learned early in my career, in that as a cable analyst, when I started with cable on Wall Street in 2002, it was still viewed as sort of two-thirds of the people who covered it were media analysts and 1/3 were telecom analysts. Today, it's all telecom analysts, and it's moved out of the media world. But
thank God.
So I would go talk to clients at, the Fidelities and the Wellingtons and the T. Rose and that sort of thing. And it dawned on me, oh, I get it. The telecom analysts were engineers in college, and the media analysts were liberal arts majors in college. And so the media analysts want to hear a story, and the engineers want to hear the numbers. And so once you knew that, you would go in prepared for each meeting completely differently. Mm-hmm. You realize that this is a media meeting. We're going to be talking stories. This is an engineering meeting. We're going to be talking numbers. And it was all you could. If you saw what the buy side analyst major was in college, you knew.
Yeah. The stories are winning now.
No question.
Stories are winning
So
everywhere
before we
now.
get to advertising, we've got to talk about what happened to Verizon today. CEO got canned, and they brought in Dan Schulman, who used to run PayPal, who did not do a good job running PayPal, because that's a stock that I know pretty well. And now he's CEO. What do we know, if we know anything?
We know very little, but I think we can surmise. Dan was on the board, and Dan is 67 years old in an industry where historically, due to the old, long-time legacy of once having been part of the Bell system, these companies have historically looked for retirement at 65.
Right.
So you can just take those two pieces of data and say, this is obviously not an orderly transition. This is not we thought it was time to move on from Hans, and so oddly they didn't name Dan an interim CEO, which
made him
I think
permanent
it's
CEO,
sort of
which is-
obvious that he's interim, but
Right. Okay.
but it was surprising to me that they didn't name him. But it has the feeling that this was quite abrupt,
Okay.
and that this if I found out, and I admit I don't know, so this is pure speculation, but if I found out that no one had any idea this was coming a week before it was announced, I wouldn't be shocked.
Okay.
It feels like it happened that quickly. And by the way, they then changed the date of their earnings call and pushed it back by a week.
Wow.
Which I was surprised that the market didn't react more negatively to that, because usually that's a
Well, that'll
bad
be an
sign.
interesting earnings call.
Yeah.
All right, so let's go to advertising. I'm going to
sir.
show it to the world. Here it is. Report 2 days ago. I actually read the whole thing.
You poor guy.
No, it was very interesting. Talk to us about. I mean, there's so much information in this report, and so much going on in the world of advertising
Yes.
right now. Give us a little flavor of what's going on.
It's actually head spinning, right?
Yeah.
Think about
Before you go,
Yes.
some of these companies, Omnicom, Interpublic, it's
Merging.
almost like those companies were companies you also could have owned for years and not thought about it. And a year later, you'd come back and say, it's up 20%, wonderful, I'll think about it next year. And now they act like death.
Yes, they do. There's a bigger statement there about ad agencies, right? So let me start with ad agencies.
Yes.
Okay.
Omnicom, WPP,
Interpublic. Why should we care, right? We should care as citizens of New York City. We should care about the health of the economy and the future employment of all our family and friends. There's going to be massive disruption in elements of the ad agency world, right? We've seen presentations from people who are developing AI-enabled tools that compress 40 jobs into one click of a button, right? If you think about just the process of creating ads, responding to RFPs, putting together marketing plans, right? That could just be done by AI, right? So we'll start there,
Okay.
right? So creative messaging.
Who's going to make my ad? Hey, Mikey, he likes it. I mean, AI is going to make that.
There's
ad?
going to be a few people with a finger on the trigger of putting some creative together, but that creative is going to be tested as it is now on Instagram and Facebook and YouTube, and they'll know instantly which is the best ad for you.
Right.
Then they'll know what's best for Craig, and they'll know what's best for me. So the earliest tip of the spear AI impact we're seeing is right now on digital advertising, right? You see the results out of Meta, how strong they are. It's because they're building better, more performing ads that are better targeted with greater relevancy, right? So that's going to be hard to win that if you're not Meta or YouTube, Google, long-term, or Amazon, right? So the people investing in AI are seeing dividends right away on the ad side, right? At the same time, and that's really more performance marketing, which is small and medium enterprises, people who are trying to sell cups, said the Real Eisman Playbook. You're not seeing Coke and Pepsi yet playing performance marketing because they're trying to build brand equity, right? What's a Coke for? What's a Pepsi? Why should I drink it now? That typically has been the domain of large, brand-driven, top of funnel, as we say, linear TV, print in its day, where basically you're trying to sell you on a brand to connect the brand and all its qualities to you, the consumer. You usually need sound, sight, and motion to do it, right? But the top of the funnel is dying quickly, right? Look at our cord-cutting monitor. We used to have 100 million homes in this country pay for TV. We're now down to 60 million, right?
Wow.
Half the country is paying for TV. In 5 years' time, it could be down to a third of the country, a quarter of the country.
So what's Coke and Pepsi going to do?
That's a problem, right? So they're going to have to basically innovate and figure out ways to do it.
And they're not going to do it with Omnicom.
They may do it with Omnicom, but it won't be the same. We need a $10 million commercial with all these people singing on a hillside about how great Coke is, right? So the ad business is fascinating to me because it's in the midst of disruption. And you clearly see that what's left in linear TV and advertising is all sports. The only thing keeping linear TV from truly dying is the NFL, the NBA, Ryder Cup, just big sporting events, right? But all the money, as we wrote, all the money is leaving the world to go to 5 major platforms.
And they are?
Google, Meta, Amazon, Microsoft, and TikTok. Right?
That's it.
Something like 2/3 of all the U.S. ad spending is going to those 5 companies.
2/3.
2/3.
Say that again. 2/3 of all advertising spending is going to 5 companies.
And that's grown by 400 basis points year over year.
Okay.
What remains is a third, call it less than $100 billion, that's not growing, right? Inside that non-growing entity are things like retail media, which is a new idea.
What does that mean, retail media?
Retail media. good example. If you're in an Uber, back of an Uber, going home from a night out at a bar, McDonald's will hit you with a message. Hey, Craig, looks like you're in Uber going home. Why don't you stop over this McDonald's on 7th Avenue, get yourself a Big Mac?
Right.
Walmart. I go on Walmart.com, or basically they say to P&G, Michael ordered toothpaste a month ago from Crest. Looks like he needs it now. Let's hit him with a message as he goes on the website.
A reminder.
Or Amazon, right? So that's growing massively quickly. Connected TV, which is streaming, is growing very quickly. But it's all coming out of the linear brand-driven world. So it's terrible. You're basically losing.
So when you go talk to like the Omnicom people, like what do they say?
They don't like me. They're like, well, what's going to happen is people will spend more on creative messaging, and that money is going to be redeployed into more media spend, right? So brands will save money on their creative,
right?
And they're going to. It's probably some truth in that, right? There's going to be a reinvestment, just more spend on marketing. The problem is you go from a human time card based monetization system where I'm giving you a time card, 20 hours worked in this campaign times $50 into a SaaS model. There's going to be disruption, right? So Interpublic and Omnicom are merging, which is like Coke and Pepsi merging.
Right.
Fox and Disney merging, which happened. Warner Scripps merging happened. Typically in our world, when you see companies that should never merge because you think their competitors merge, there's problems down the road, right? That's been the history of observing what we've observed for 30 years together, right? So there's going to be a bottom in these stocks at some point. They're merging in a month or two, but just the headline risk about changing employment trends should scare all of us. Really.
I had a very short stint in advertising, and I remember seeing the same thing when Meta said that you can send your brand logo to us and nothing else, and we will create a fully produced television ad for you. And start A/B testing it that same afternoon. And by the end of the day, we will have the most effective 15 versions. You just thought the agency business is over. I mean, how can now? Obviously, initially, just like every form of disruption, the old Clay Christensen model, it's going to be the smaller brands that never had the ability to advertise before, and suddenly have the ability to create something that is a fully polished AI-driven ad on TikTok. But the technology is going to get better and better and better really quickly, and there's just no way that an army of people can be cost effective against that kind of a model.
And this is going to blow through industries, right? Like,
so how do you think
think about law firms, think about accounting firms, right? Just think about all these entry-level jobs where people are just doing rote types of skills.
It's going to be gone.
It's going to be gone.
Youth I saw it says the unemployment rate in the United States today is 4.5%.
Yeah.
Youth unemployment's 11.
Yes.
And going up.
Yes. The irony, we joke with this all the time, that if you had a son or a daughter who was a trained engineer and said, look, go to engineering school, learn how to code.
Right.
Now they're coming out of college. Exactly.
Yeah.
Exactly. You missed the window.
Right.
And when we hear
unbelievably disruptive.
And when we hear about the agencies that basically have built these SaaS models, they're saying like 30% of their engineers will be gone in a couple of years once they reach peak efficiency in building out their models.
Right.
It'll just be reinforced by AI, right? So once you prove that it works, you'll augment it by using computer,
So what you're saying is that there are entire scores of industries people can lose their jobs or not get jobs.
Not scores. There will be levels of industries. You'll still need that, to your point, the great creative person, the great media mind to plan.
But you don't need an entire team
wrapped
of
people,
it.
Right, exactly.
And then the obvious question is what are the multiplier effects of those lost jobs?
Right.
People talked for a long time about autonomous vehicles are going to replace truck drivers.
Right.
And I heard somebody saying the other day, well, it turned out that didn't happen. Well, okay, it hasn't happened yet, but do you really think that it's not going to happen?
Right.
And when it happens and you lose, I mean, already, by the way, we're going in a different, darker direction, I guess. But the first place where AI really started to make a difference in jobs was call centers. The very first place. Call center jobs may seem like a dead-end street type of job.
But they employ a lot of people.
They employ a lot of people, and they employed a lot of people in really important times, in that it was often a job, especially post-pandemic, that you could do from your home. And so there were a lot of single and battered women and that sort of thing that said, this is my lifeline. Those jobs are going away. And so you wonder, as these types of jobs start to go away, what happens and what's the backfill for those kind of jobs? You can't have an economy where everybody is just working in retail stores selling stuff to each other. You actually have to have some productive jobs. And if if
Podcasting.
Exactly.
podcasting is good. Yes, podcasting is good.
It's funny because I used to spend a lot of time covering media and entertainment, and there was a report in the Journal this week about how many jobs in LA have been lost in media because of strikes and streaming wars coming to an end and consolidation, right? You just think about, a big part of LA was built on entertainment, and that's now changing. And all those people who had lifelines, even people who providing, the food for the shoots or the tape, the gaffer tape to do the microphones.
Right.
They're not working.
No, not working.
Yeah.
All right, let's change gears quickly. We got one more thing we've got to talk about. David Ellison, Paramount. He just bought the Free Press.
Yes.
He just put Barry Weiss in charge of CBS News. I'm sure half the staff at CBS News is having a conniption fit as we speak. But he's also trying to buy HBO. What do you think?
Well, first, I think that we should have sold our company to David Ellison because I think So I'll put it that way. So congratulations, Barry Weiss.
Yeah,
great,
no kidding.
Great transaction. There needs to be more consolidation. There's too many streaming options, right?
No kidding.
We've been writing about this for years. What's the end game, right? We have three people around a desk. We've got Comcast, Peacock, Warner HBO, Paramount. Of those three, Paramount will be the least likely to consolidate because in its former state, they had a terrible balance sheet and not much scale, right? So we always thought, Warner's and Comcast should get together, right?
Right.
David Ellison has upended the most logical progression what's going to happen, right? By him showing up with
buying Paramount.
with a balance sheet, buying Paramount,
Right.
and showing from day one he's committed to building a business. All of a sudden, Warner's looks like a possibility for him. And by buying Warner's, he would take Warner Brothers Studio and HBO and merge it with Paramount Plus and Paramount Studios and be a top 2 or 3 streaming player.
And by the way, back to Comcast, ordinarily you would have thought, well, Comcast is obviously the one that's going to buy Warner Brothers, and they fit together like a glove. So that will be
Why do they fit together like a glove?
one broadcast network instead of two, so no divestiture of the second broadcast network. And a
lot of the shows on Warner's are on NBC.
Yeah,
Right.
it's a very complementary
Harry
stuff.
Potter, theme parks.
Theme parks. So there's a really complementary fit there. But I think in this administration, you have to concede, and I think even the people in Philadelphia at Comcast would concede, Comcast doesn't have a snowball's chance of getting any transaction approved in this administration.
But David Ellison does.
Yes.
Shockingly.
Yes, this
Shocking.
is a pay-to-play administration,
Right.
and if the ask for Comcast would not be you have to put a bunch of money into some investment that's favorable to the administration. Instead, it would be you have to change the media bias of NBC to be right-wing.
Right.
And you have to shut down MSNBC, and you have to do all kinds of things that would cause half the staff to quit.
leave.
And so there is really no realistic chance that Comcast is going to be allowed to play in this consolidation until
But
this
let's talk about
administration's over.
HBO, though.
Yeah.
Like, if I was running HBO and David Ellison showing up with a check, like, here, take it.
Yeah.
This is such a difficult job now. Take it, please. And why is that not happening?
I think it's going to happen because I think to the big picture point, there's too many streaming choices, right? You
Right.
need to take out a competitor. And he realized right away, probably when he was buying Paramount, that this was the first step out of 2.
Right.
Right. That Paramount Plus needs HBO.
Right.
And all of a sudden, who's left? You've got Netflix winner,
Right.
Amazon in it for a different business,
Right.
Disney winner. And now you have a chance. What does Peacock do in a world that HBO and Paramount are together, right?
Right.
So all of a sudden, he's got global scale. Ellison has said, rightly so, his future is in sports, streaming, and studio. Studio box checked. You have Warner's and Paramount.
Right.
Pretty damn good. Streaming, yes. HBO on its own is hard. But look, they have things like Yellowstone sitting on there, all this content. And then sports, You'll take all the Turner Sports and put it on CBS. All of a sudden, they're a legitimate company after that combination. They really are.
So you think it's going to happen?
I think it's going to happen. I think to Craig's point about politics, why won't it happen?
Yeah.
Why won't it happen? Right? The issue has always been, well, regulatory and who cuts the first check. David Ellison will cut the check, and regulatory seems like not an issue right now.
Yeah.
And I don't think that Barry Weiss, you started with that hook. I think
That helps.
it does. I think everything they've done has said we will be less adhering to a point of view that seems a liberal point of view. We will be down the middle, and that's all you want is down the middle. That's the pitch to DC.
That's the pitch.
Yeah, but also I think we cannot continue with the structure that we have in place. There needs to be consolidation.
Yeah, I agree.
There's too
I
much-
subscribe to everything, but it's even absurd for me at this
Yes,
point how
yeah.
many things I subscribe to. It's absurd.
I agree. Yeah.
It's really, it's sad though, because I see this, and I think Craig sees it in his world too. We rode these horses for 25 years. Like this was a great sector to cover.
The best.
The personality is a great business model. It's just, the deals and all the news.
Right.
And now it's going to be consolidated down to a couple players who, are larger than anyone, they're larger than the street in terms of they're bigger than the street.
Right.
Netflix doesn't need the street. They tell the street what to do. And
Right.
David Ellison's bigger than the street. And all of a sudden, they just go on their own. It's like, so we're at this point now, we're probably the 8th inning of how the sector
putting it
looks.
together.
Yeah. So what's your take on our world, right? So flip it around. You own T-Mobile.
I own T-Mobile, but I feel like it's getting a little long in the tooth.
Yeah, that was Craig's
I
view.
own I own all the Mag 7 except for Tesla. I own some other tech stocks.
Yeah.
But what I'll tell you is that I've been bullish about the market for a very long time. And for the first time in a long time, I developed a twitch in the back of my eyeball. And the twitch this is a very interesting statistic. So GDP 2024 was 29.18 trillion. And the consensus estimate this year is for 1.8% growth. So 1.8% times 29.18 is 530 billion. Now, you add up Meta, Google, Amazon, Microsoft, ChatGPT, blah, 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 what they're all spending on AI, and you get easily over $400 billion.
Yeah.
So what that tells you is
The rest of the economy
the
is
rest of the
shrinking.
economy is not growing.
Yeah.
Right.
So we basically have, the technical term is we have a K-shaped economy. And you're starting to see stress. I mean, consumer credit, you're seeing youth unemployment being a problem. The housing market still stinks because rates, even though they're relatively low relative to history, are much higher than they were during the pandemic. The consumer credit quality is deteriorating slightly, but the consumer is not spending as much. There's cracks. So, a couple of weeks ago, I had Dan Ives on.
Yeah.
If you listen to, and he was wonderful, but if you listen to Dan Ives, you'd buy every single tech stock on planet Earth. But there's something not quite sitting right with me right now. So I've lightened up a little bit, but I don't know what else to do.
Yeah, it's funny you say that because what I described about, these big five companies are taking all the incremental dollars out of advertising.
Right.
The ad pie in the U.S. just isn't that big to support that level of CapEx.
Yeah, right.
So we've been asking ourselves, what else can they monetize? Because it's obvious advertising can't support
What they're spending.
Exactly. So it has to be something else.
Yeah, we were having this conversation about the lesson from the 99 bubble was that if you think about the value chain of manufacturers and all the way up through end users, there's a lot of revenue that's created between layers of the value chain, and it's important to tune it out and say, I don't care. All I care about is, at the end of the day, what's coming into the value chain from end users and advertisers. So whether it's consumers, whether it's enterprises, including governments and militaries, or whether it's advertisers, that's where the money has to come from. Everything else is vapor. And so there's no question that OpenAI is spreading its money around, and that money is real revenue to the companies that they're spreading it to. And,
Correct.
And the companies that are buying chips from NVIDIA are spending real money to buy those chips.
And they're not borrowing, by the way.
They're not borrowing,
That's coming from their cash flow.
Yes, but But you still have to think about, okay, but is the revenue that's going to come in, either is now or soon, is going to come into the value chain, is it enough to support that level of investment?
Well, it can't be just from advertising.
So, well,
No,
no,
it
not
can't
just
be.
advertising.
Yes, exactly.
But it's, you can make the case, all those jobs that we're talking about disappearing, that productivity enhancement, it's easy to imagine the bull case that that if I'm a company and I think, well, I could replace a $125,000 employee, and therefore I should be willing, with an AI bot, I should be willing to pay up to $119,000 for that, or $124,000 for that AI bot. Right now, it may not be one for one, but you get the idea, right? I'll pay a lot for that bot, presumably. So the bull case is that enough companies are doing that the revenue is going to be sufficient to support all this infrastructure spend. The bear case is, no, you've got 4 people competing for that opportunity, and they're going to drive the price down so that you can't imagine a scenario where the price of those bots is going to be high enough to support the infrastructure. And I think anyone with
By the way, where we are right now, you could say whatever you want. It's too early.
Yeah, too early.
Exactly.
It's too early.
Exactly.
You can dream any dream you want.
Well,
there's no counterfactual.
Right. What
No.
I was going to say is, I think we would all say with some humility, we don't know the answer to that question yet.
Oh, I totally agree with that.
And
Right. You can't dismiss it, but you can look at the investment levels and say, what's the ROI? Trying to dream the near-term ROIC is not going to be very pretty given the spending.
Right.
Right.
Totally.
There's going to be there'll be a point, of course, when we don't know when that point is, when someone's going to have to prove this makes sense. And
Right.
it's really on Sam Altman's shoulders to prove this makes sense. Yeah.
All right, guys. That was great. Thank you.
enjoyed this.
That
Thank
was
you.
really
Yeah.
great. This podcast is for informational purposes only and does not constitute investment advice. The host and guests may hold positions in stocks discussed. Opinions expressed are their own and not recommendations. Please do your own due diligence and consult a licensed financial advisor before making any investment decisions.